Hi, everybody. This is Thursday, April 9th, 2009. I'm Peter Schiff. In case you don't know, I actually am going to be on ABC News Good Morning America this Sunday morning. And then again, they're going to run, I'm not sure if it's the same footage or different footage, on the ABC Evening News. So make sure to check it out. Hopefully they'll have some good stuff. I certainly talked to them for quite some time. We taped it, I think, a few weeks ago, and they're finally airing the interview. Anyway, the markets were strong today. U.S. market has rallied significantly intraday, basically on the strength of earnings being reported by Wells Fargo. At least that's the excuse. Wells Fargo came out with much better than expected earnings. I really don't know why anyone is paying attention to earnings come out of the financials. I understand the financials are down, but they're beaten down for good reason, and they're going to have a lot of problems in the future, far more than they've already experienced thus far. And in fact, any profits Wells Fargo has today, I'm sure, are sowing the seeds of future losses. Because whoever lending money to, whether it's American consumers who are money to buy things, or American businesses who are borrowing money to help sell things to American consumers, all these loans, I think, are bad risks. I think our economy is really going to implode, and Americans are simply not going to be able to repay these loans. Most of these loans shouldn't be being made in the first place, and be being made if the government wasn't bailing out companies like Wells Fargo with TARP money. They weren't in the markets bidding for the assets that are polluting the balance sheet of companies like Wells Fargo. Now, I'm not sure in Wells Fargo's earnings how much tricks there are there, assumptions have been made. I'm not sure how much the new accounting rules, where you don't have to mark your your assets to market, are impacting their earnings, if they're even in effect yet. But certainly, if because of these new accounting rules, Wells Fargo is not reporting write-downs that it might otherwise have required to report, then that would be an explanation why the earnings are better. But the strength that we're seeing in the U.S. stock market is still mild compared to the strength that we're seeing abroad. This is a broad-based rally in global stocks. I'm still convinced here in the U.S. that we're looking at a bear market rally. I still expect the U.S. market to make a new low in nominal terms. If it doesn't make a new low, it'll only be because inflation is so essential that a new low is not possible nominally. The market will make many, many new lows in terms of yen or even other foreign currencies that will lose less value than the dollar. But I think some of the markets abroad, these rallies could be more legitimate, more long-lasting. If you take a look at the Hong Kong market, the Hang Seng bottomed out in October of last year, and we are now 40% above that low. Now, the U.S. market, after it set a low in October, set a new low in November, and made the newest low in March. Now we've had this big rally, but all that's happened is the U.S. market is now back up to the levels of the October low. Meanwhile, the Hang Seng is 40% higher. So in a time where the Hang Seng has gained 40%, the U.S. stock market has gained nothing. And I think that's really a proxy for things that are going on in Asia. And of course, if you look around the world at other stock markets and other stocks that I follow, the gains seem far more impressive than the gains that we see in the U.S. market. Now, granted, foreign markets were down more than the U.S. market, but that's also because we're up so much more than the U.S. market in the 8 years preceding 2008. But I think what's more important is what we're seeing now, this divergence, the fact that other key markets did not make new lows, while the U.S. market did. So the fact that lows held in other markets indicates to me that there is some underlying strength in markets, and money is beginning to flow back out of U.S. assets into foreign assets. Ultimately, I think the flows are not going to simply be out of U.S. stocks, foreign stocks, but out of cash into stuff, as people around the world do appreciate how much risk there is in holding cash. Right now, they've been focusing on the risk of holding assets, and that assets might fall in price. Soon, they're going to start to focus on the risk of holding currencies, and currencies losing purchasing power, and they'll flee to assets. And I do think that while we have seen some strength in stocks and in metals, we've seen some weakness in the precious metals. I think the demand for gold will rise shortly as people realize that behind whatever growth assumptions there are, or whatever optimism there is, a lot of inflation. And there is the hope that inflation is going to revitalize the markets. It won't, but it will certainly make prices rise. It could make stock prices rise, but it will make consumer prices rise even more, and it will make gold that much more appealing as a safe haven, as a store of value. So this is still an opportunity to buy the dip in gold and to buy the dip in the gold stocks. So turning to the economy, we got news today on the trade deficit. The trade deficit actually shrunk to the lowest level in 9 years. The monthly deficit is down to $26 billion. Now, $26 billion seems like a small number, only when you contrast it with the $60 billion a month that we were running for many, many months in 2003, 2004, 2005. But it's still a horrific number. $3 billion trade deficit is still huge. It's only not huge in comparison to the prior deficit. But the fact that the deficit is coming down should not necessarily be seen as a positive for the dollar. You know, you would normally think, well, a shrinking trade deficit is good for the dollar. Well, you know, the soaring trade deficit didn't sink the dollar. So I don't think in the short run an improving deficit is going to help the dollar, especially when the deficits are still quite large. I think what's important is to focus on the accumulation of all the previous deficits. We ran these huge deficits month after month, year after year. We ran up our national debt. There are a lot of dollars in the hands of foreigners that are ultimately going to come back on the market that will lift the dollar, despite the fact that our trade deficit has shrunk. In fact, part of the solution to our economic problems is going to involve the elimination of the trade deficit. We're going to have to start running a surplus. But this is going to happen in the confines of a shrinking dollar. And also another item to ponder, one of the reasons that the Chinese bought so many treasuries because they had a huge trade surplus that they foolishly recycled. They used the dollars that they earned selling products to buy our financial assets. So they, in effect, loaned the money back to our government. But now that the trade surplus is much smaller, and the world is earning far fewer dollars exporting to the United States because we're obviously far too broke to claim. Even though we were broke before, we were able to get credit. Now we can't. But of course, you know, part of it was simply that Americans didn't know they were broke. They thought they had a lot of home equity. They thought they had a lot of money in the stock market. Now that they're finding out that that's not the case, they're making the rational decision not to keep her into debt, to try to rebuild their savings legitimately. So the fact that we're no longer buying so much fraud and we're no longer giving them so much cash to recycle, how is it that they're going to finance huge deficits that we're running now? Because now they have to dig deeper into their own pockets to do it. And obviously there's less incentive. The old argument was you need to support us because we're buying your stuff. Well, if we're not buying anywhere near as much of their stuff, why do they have to up the level of support? It would make sense. We're not buying as much of their stuff. They see an opportunity that, hey, maybe we don't have to buy as many of their treasures anymore, which means with bigger difficulty financing this, which of course means that we're going to rely far more heavily on Ben Bernanke and his printing press because we're not going to be able to rely so much on trade deficits. Anyway, that's it for today. Everybody have a great weekend. Tomorrow I know is Good Friday, and hopefully I'll be again blogging early next week.